You walk out to the mailbox on a completely ordinary afternoon. You flip past grocery flyers and the power bill, and then you see it, an official envelope from the IRS. Surprised, your stomach knots a bit. You open it, assuming it's a routine notice. But it's not. It's a penalty. $10,000. And the worst part? You have no clue what you supposedly did wrong. You didn't stash money overseas. You're not running some side business under the radar. You didn't cheat on your taxes. All you did was deposit some cash from selling your truck. Or maybe your daughter helped with medical bills and handed you some money. Maybe you moved funds around to finally fix that old roof. Size. Totally normal stuff for retirement. But in 2026, normal doesn't automatically mean safe. Because what's setting off these penalties isn't classic criminal behavior, it's patterns. Patterns picked up by automated systems that don't know your life, your health, or your family situation. And once the system decides something looks off, the starting penalty for one violation can be $10,000. Today, I want to walk you through what's actually going on, why so many retirees are getting blindsided, and the one simple mistake that can turn an innocent trip to the bank into a federal headache. Hi, I'm Artur, and I spend my time helping retirees protect the nest egg they spent a lifetime building. And there's a quiet but major shift that's taken place in the financial world this year that you need to understand. The rule I'm talking about is not new. It's been on the books for decades. What's new in 2026 is how it's being enforced. Faster, heavily automated, and far less forgiving when things don't line up perfectly on paper. My goal here is not to scare you. It's to make sure you really understand what kinds of everyday bank activity can trigger serious penalties, the one smart move that actually creates big trouble, and how to protect yourself so that $10,000 surprise never shows up in your mailbox. Because once you see how the system actually works, you'll realize the real risk is not obvious at all. And that's exactly why we need to talk about it. Let's start with what's catching people completely off guard: ordinary transactions that look totally harmless. Think about this. You sell your old pickup for $15,000 in cash. The buyer counts it out, you head to the bank, and you make a deposit. Straightforward. Or your son wires you $20,000 to help with sudden medical costs. Or you finally take that lump sum pension payout you've delayed for years. Or you shift a big chunk of savings from one account to another because you're putting money down on an RV. None of that is illegal. None of it is shady. It's life. It's retirement. It's your money. But here's where the landscape has shifted in 2026. Banks aren't just holding your deposits anymore. They are automatically reporting certain kinds of activity. And those reports don't get stored in some dusty file room. They're pumped straight into systems that scan, sort, and cross-check them against other data looking for inconsistencies. So when a large amount of cash hits your account, the system doesn't see "sold my truck," "gift from my daughter," or "pension payout." It just sees numbers. It sees patterns. And if those patterns don't match what shows up on your tax return or other financial records, a digital flag goes up. From your point of view, you're handling your finances responsibly. From the system's point of view, it's asking two narrow questions. Where did this money come from? And was it properly reported? If the answers aren't crystal clear in the data it can access, problems can start. Here's the twist that surprises almost everyone. The core rule behind all of this isn't new at all. It's been around for a long time. What's changed is the intensity and efficiency of enforcement. At the center is something called a Currency Transaction Report, or CTR. Despite the intimidating name, a CTR is simple. By law, banks have to file a CTR anytime someone makes a cash transaction over $10,000. That includes big cash deposits, large cash withdrawals, and some transfers involving cash. So if you walk into the bank and deposit $12,000 in cash, the bank fills out a CTR and sends it to the government. You don't fill it out. You may not even know it happened. It's all behind the scenes. Here's the key. A CTR is not a penalty. It's not an accusation. It's not proof you did anything wrong. Millions of CTRs are filed every year. For years, this has been routine. Business owners deposit cash, people sell vehicles, families shuffle money, the bank sends the form, and life goes on. So if that's been the law for decades, why are retirees suddenly hearing about $10,000 penalties? Because in the past, those reports mostly just sat in a database unless a human investigator had a reason to dig. Today, that's not how it works. Now those CTRs are immediately fed into automated systems that match them against tax returns, Social Security records, pension and IRA distributions, other financial reports. The system isn't just collecting information, it's analyzing it in real time. And when something doesn't line up, that's when the trouble starts. But there's another layer to this that's even more dangerous than a simple large deposit. It's a mistake well-meaning people make all the time thinking they're actually being cautious. And in the eyes of the IRS, that one decision can turn a completely legal transaction into a federal violation. That's what we need to get into next. Here's where everything changes, and where many honest, law-abiding retirees unintentionally step into a danger zone. Imagine you have $12,000 in cash. Maybe you sold a boat. Maybe you had cash saved at home. Maybe it's money that's been sitting in a safe for years. You walk into the bank. Just before you get to the counter, a thought hits you. If I put this all in today, it'll trigger a report. I don't want any extra attention. I'll just deposit part of it now and part later. So you deposit $8,000 on Monday. Then you come back on Wednesday and put in the remaining $4,000. From your perspective, that feels harmless, maybe even wise. You're not hiding income, you're not avoiding taxes, you simply don't want any additional government paperwork. Seems reasonable, right? Under federal law, that choice can completely change the situation. This is called structuring. Structuring is when someone deliberately breaks up a large cash transaction into smaller pieces for the purpose of avoiding that $10,000 reporting requirement. And here's the part that shocks people. The money itself does not have to be illegal. It doesn't matter if the cash came from your pension, the sale of personal property, a gift from a family member. If you intentionally slice up the deposits just to stay under the $10,000 threshold, that act alone can be treated as a federal violation. And yes, penalties for structuring can start at $10,000 per violation. Let's make the contrast crystal clear, because this is critical. Scenario 1. You walk into the bank and deposit $12,000 in cash in a single transaction. The bank files a CTR. End of story. Routine. Legal. No crime, no penalty. In most cases, nothing else happens. Scenario 2. You decide to deposit $8,000 and then $4,000 separately, specifically so no report will be filed. Now you've created a pattern that these automated systems are designed to detect. And they are very, very good at spotting patterns. They look at timing amounts, how often you deposit, the way transactions cluster over days or weeks. If it looks like someone is deliberately staying below the threshold, alarms go off. And here's the uncomfortable part. The system cannot read your intentions. It doesn't know you were just trying to avoid attention or keep things simple. It only sees the pattern. And the pattern is what matters. This is where good people get hurt. They think they're being careful. They think they're staying off some imaginary radar. In reality, breaking up deposits to avoid a report is exactly what puts them on the radar. So let me say this as plainly as possible. Having a currency transaction report filed on your behalf is not a problem. Trying to avoid that report by splitting up deposits can be. And that's the big shift in 2026. With advanced automation, constant cross-checking, and real-time analytics, these patterns are no longer slipping through the cracks. The system doesn't need a person sitting at a desk watching your account. It flags inconsistencies automatically. It matches deposits with tax returns. It compares reported income with cash activity. And when something doesn't line up, letters and notices can go out with no human in the loop at the start. Before this turns into anxiety, take a breath. The IRS is not out to punish retirees who are simply managing normal finances. The vast majority of people who make legitimate deposits, even big ones, never have a problem. The real danger is misunderstanding how the rule works. So here's the first major takeaway. Never break up a transaction just to stay under $10,000. If you have more than $10,000 in legitimate cash, deposit it in one go. Let the bank file the report. That's what the system expects. That's what keeps your situation clean. If this is already clearing things up for you, take a moment to like this video and subscribe. I share updates like this to help retirees avoid costly mistakes before they happen, not after. Now that you understand structuring, we need to talk about something just as important: how to protect yourself going forward. What simple habits can you build so that, even in this highly automated environment, you're never scrambling to justify your own money? Let's shift from awareness to protection. This isn't about fear, it's about being prepared. Yes, enforcement in 2026 is more automated, quicker, and less tolerant of gray areas. But protecting yourself is simpler than you might think. You don't need fancy legal maneuvers or complicated loopholes. You need three things: organization, clarity, and a paper trail. Step 1, and this is the big one: document everything. Anytime a sizable amount of money moves into or out of your accounts, you want clear records showing where it came from and why. A few examples: sell your car for $15,000, get a signed bill of sale, make a copy, scan it, save it. Your daughter gives you $20,000 to help with medical bills. Ask her to write a simple note stating it's a gift, the amount, and that it's not income or a loan. Take a lump sum pension payout. Keep all the distribution paperwork with your tax records. Withdraw cash for a big purchase, like a contractor or a vehicle. Keep the invoices and receipts. The goal is straightforward. If anyone ever questions a transaction, you can immediately show the money's source and purpose. Here's what most retirees don't realize. The IRS computer doesn't automatically know the context behind any deposit or withdrawal. It only sees numbers. Your documentation supplies the story behind those numbers. When that story is clear and backed up with paper, issues are a lot easier to resolve. Step 2. If your financial life is more complicated than just Social Security and a modest pension, this is the year to sit down with a qualified tax professional. A good CPA or tax advisor doesn't just plug numbers into a form. They help your tax return tell a complete and consistent story. If you sold property and got a large deposit, it should line up with what's reported on your taxes. If you received a sizable gift, they can help you handle any reporting and documentation correctly. Automation flags mismatches. A tax professional helps prevent those mismatches in the first place. Step 3. Be open with your bank. This one often surprises people. There's no downside to asking your bank how they handle reporting. In fact, transparency works in your favor. If you're planning a large, legitimate cash deposit, just do it properly and let them file whatever is required. Remember, a CTR is standard procedure. It's not a mark against you. It's trying to duck that report that causes problems. When you combine these three habits, good documentation, pro help when you need it, and honest communication, you dramatically reduce the chance of that $10,000 notice ever landing in your mailbox. Let's put this in perspective. The automated systems in 2026 are powerful. They link information instantly. They compare deposits with tax filings. They catch patterns a human might miss. But they are still just data tools. They rely on consistent, sensible information. When your records are organized and your transactions are straightforward, you're operating exactly how the system expects. This isn't about hiding, it's about clarity. And if you know another retiree, a friend, a neighbor, someone at church, who still thinks keeping deposits small is a clever move, share this with them. A simple misunderstanding can easily become a $10,000 problem because the financial world has changed. The old days, when small inconsistencies could slip by unnoticed, are disappearing. We're now living in a fully digital enforcement era. The people who adjust early are the ones who avoid unnecessary stress. Let's zoom out to the bigger picture. The enforcement shift we're seeing in 2026 isn't a test run. It's not a temporary program. Automation is now built into how financial oversight works. The systems are faster, more connected, running constantly in the background. That means the retirees most at risk are not the ones doing something obviously criminal. It's the ones operating on outdated assumptions. For years, people believed, if the bank isn't raising an eyebrow, it must be fine. If you kept deposits small, stayed under the radar, or handled things quietly, you were being careful. In today's environment, deliberately trying to stay under the radar is exactly what creates your radar signature. One straightforward $15,000 deposit backed by a bill of sale? Routine. Logged, processed, forgotten. Several smaller deposits clearly structured to dodge a report? Pattern detected, flag raised, questions asked. The system isn't emotional. It doesn't assume you're a criminal, but it is designed to treat any pattern that looks like report avoidance as something worth examining. And once that examination starts, it can be stressful, slow, and expensive to unwind. Now let's ground this in some reassurance. Most retirees watching this will never face a structuring penalty. Most large deposits, when done properly and backed by records, sail through with no issue. The goal here is not to make you nervous every time you go to the bank. The goal is to replace uncertainty with understanding. Because when you understand, you act differently. When you know a currency transaction report is routine, you stop fearing it. When you know structuring is about the intent to avoid reporting, you stop accidentally creating risky patterns. When you realize documentation tells your financial story, you start keeping the records that protect you automatically. This really comes down to mindset. The old mindset was, keep it quiet. The new mindset needs to be, keep it documented. That one shift can save you a huge amount of stress. So ask yourself honestly, if a fully digital IRS system reviewed the last 12 months of your financial activity, would the story make sense on paper? Would every large deposit have a clear explanation? Would the movement of funds match what's on your tax return? If the answer is yes, you're right where you should be. If the answer is, I'm not sure, this is the perfect time to tighten things up. Organize your records. File paperwork properly. Scan important documents. Meet with a tax professional if anything feels fuzzy. Not because you're in trouble, but because preparation is always cheaper than penalties. You spent decades building your retirement. You sacrificed, planned, and made careful choices so you could enjoy this phase of life with stability and peace of mind. The last thing you need is a preventable $10,000 penalty caused by a misunderstanding of how bank reporting works. The rules themselves haven't radically changed. What's changed is the speed, visibility, and automation behind enforcement. The retirees who thrive in this new environment aren't the ones who panic. They're the ones who adapt. So, deposit large amounts properly in a single, honest transaction. Never split cash up just to dodge the $10,000 threshold. Keep records for any significant financial move. Make sure your tax return matches your real financial life. Treat transparency as protection, not as a risk. When your financial paper trail is clear, organized, and consistent, there's nothing for automated systems to argue with. And that's where real peace of mind lives.